Hey team, hope everybody's doing well. Happy Tuesday. And today the title might be a little bit scary, but I will touch on some things that are pretty rough out there. So I hope everybody can hear me okay. And we will talk about a continuation of how January has been. Now today, different to usual, I'm going to start with the ugly news first, because there is some pretty ugly news. And then the good news towards the end. So it's also a pretty big deck. So let me know in the comments below if these types of things are too long, but there's simply too much to share. And of course, edutainment. And I'll go as fast as I can. But before we jump into the ugly news, I'm going to talk a bit about what happened over the last week. So here you can see the market. Now, this is the market divided by Bitcoin, and it shows you how strong Bitcoin has been performing. In fact, the few names that have outperformed it are things like Polkadot, Near, XRP, Filecoin, Hedera, Shiba Inu. So it's a weird situation. Let's see how we performed over the last week against dollars, US dollars. You can see here, wow, Bitcoin up 8.66%, Ethereum 2.49%, BNB, XRP, Doge, everything is kind of doing well all across the board. Very, very good market depth. Let's talk about equities before we jump in. And you can see here the last 7 days of equities, and technology is back. Big results, nearly 20% for Tesla, Google up nearly 8.5%, Apple 4%. Microsoft had earnings, and they just missed by a few pennies a few minutes ago. But the stock is up, and after hours, I guess people are excited by their AI. And a lot of questions are still coming in about, wow, is Google screwed? Is Microsoft going to beat them? So let me know if you're interested in me doing a big dive on my thoughts. I do have zero Microsoft, and I do have a Google position. So it's good actually for me to do that exercise as well. So let's talk about some of the ugly news for today. And there's a lot. So first of all, sadly, this is the job postings. And a big thank you to Sanjay for sharing. This is job postings on Indeed.com and changed from a year earlier. The gray line is overall postings. Dark blue, banking and finance. Teal, human resources and software. Basically, the big difference is help is no longer wanted, which is stunning to see. Now, we all heard about all the big tech layoffs, but the question is, did they really need to lay off all those workers? When you look at the huge cash balances that they have, you can see Amazon laid off 18,000, and they have 60 billion in cash, and they make 11 billion in profit over the last 4 quarters. Google, biggest layoff ever, 6.4% of their workforce, 12,000 employees. And they've got 116 billion in cash. Meta, 12.6%, double the cut that Google had, 11,000 workers. And they have 42 billion in cash. And Microsoft, 4.5% of the workforce, they have 107 billion in cash. So these companies are massive cash cows. And it was very concerning for a while back when they were getting nothing on their cash. It was just like a melting ice cube. But now they can at least get 4% from short-term treasuries and maybe some other assets. Let's talk about the E and the P in price to earnings ratio. Here, this is the S&P 500 net profit margin from Q1 2019 to Q4 2022. You can see the peak was Q2 2021 at about 13%. And since then, we've been going down. Now, historically, the profit margin was quite high for many of the companies in the S&P 500, but you can see in Q4 2022, it's looking to take a big haircut down to about 11.4%. And when the earnings fall, that impacts the price because everything's driven off P/E ratio. Let's talk about the kind of part of the motivation for the title was this chart here. And I said recession indicators reveal ravaged realities. So if you look at this here, this is a leading indicator of the economic index, and it typically presages a similarly dark economic outlook. And this is a compilation, I think, of about 10 indicators that have historically always led recessions. And they include the shape of the yield curve. They measure things like interest rate sensitivity, manufacturing, housing activity, the labor market indicators, all the type of stuff that Jerome Powell is set on destroying, and he is succeeding very well, by the way. But when the index falls sharply on a year-over-year basis, and most of the indicators are down, as is now the case, recession follows 6 to 12 months later. And while the index fell for the 10th straight month in December, the year-over-year decline is not as sharp as seen during previous downturns. So there could be a glimmer of hope for the so-called soft landing. Many people think it's impossible, but who knows? Let's look at this one here. This is the leading indicators year-over-year decline. Blue does not bode well for the real GDP growth, which is orange. Now, blue is the conference board of US leading index, 10 economic factors I just covered, compared to GDP. And the initial reading for fourth quarter 2022 coming this Thursday, 2 days from now, could be bad. But then again, you don't really know with government numbers because sometimes they give you an initial number and then they revise it a couple of quarters later. So you don't know what you're going to get. Let's talk about PMI. The S&P 500 Global PMI Purchasing Managers Index Composite is a measure of the health of the manufacturing and services sectors of the economy. And what you can see here is a slight little uptick, which is not too bad. And here as well, a reading above 50 indicates typically an expansion of activity, while a reading below 50 indicates a contraction. Right now, I think the reading is up to 46.6 versus the expectation of 46.4, and it was 45 last month. So it is getting better, but still bad. Again, under 50. Recessionary territory. Not good. Sorry about all these macro numbers, but it does set the tone for where the markets could go in the very near future. Now, this is from Macro Alf, and he talks about the, again, conference board new lows for US leading indicator index. This indicator has 100% hit rate on anticipating recessions with a 7 to 8 month lag, and it's now pointing to a recession starting in Q2 2023. And on par with the 2001 recession, which was pretty nasty. Now, the markets in the meantime believe, according to Macro Alf, soft landing, la la land. But remember as well, as I always say, the markets are forward-looking. So they look way beyond when the recession will hit. And that's what we're kind of seeing. So they bottom earlier and they recover faster before you even know you're in a recession. Final piece, this is scary. KB Homes, it's a very large home builder in the United States. They just reported a 68% cancel rate on contracts. And this is stunning. This means that home buyers cancel 68% of the homes that went under contract in the quarter. And 1 year ago, the cancellation rate was only about 13%. Again, in quick summary, you have JP. He's now destroyed the housing market, real estate market, millions of jobs, trillions in wealth. He's destroyed manufacturing and orders. So job done, but they're still going to raise rates February 1st and take us deeper into financial Armageddon. But the irony is as well, they're always shooting themselves in the foot because their deficit's going to explode. There'll be no tax revenue from 2022. And of course, they're facing nearly $1 trillion in interest debt on already huge deficits. So it's very, very bizarre. Let's talk about Europe for a second. This is interesting. If you look at all these countries, you can see how wage growth kind of tracks CPI in some places. Not necessarily in Germany, but in France, it is bang on. Not in Spain, not in the Netherlands, not in Italy, not in Ireland, and not in the UK. And it's funny, I don't have any subscribers in France for some reason. Either they don't like crypto or don't want to watch an English-speaking channel. But the French have a strong culture of protests and social activism and a tradition of standing up for workers' rights and a political system that allows for strong labor unions and a history of dissatisfaction with the government policies and high taxes, which all brings about to a high frequency of protests in France. And I think they say Liberté, égalité, Fraternité. Who knows? Maybe that's why these guys are able to track wage inflation with CPI, the only place. And I think that's fascinating. So who knows? Now, Japan. Last week I talked about Chinese shrinkage, negative birth rate. Well, Japan has the same thing. And Kishida says Japan is on the brink of social dysfunction as births have fallen. And in Japan, they prefer doing other things than having families. So with that, let's get into the bad news and then the good news. There's not too much bad news today. First of all, a very important thing, and I touched on it in a video the other day, I think it was Saturday, how it's important to look at volume that is traded on a token, market depth, spreads, that type of stuff. And this was a cool analysis from a group that analyzed the top 28 crypto assets using 3 liquidity metrics: market depth, spreads, and trade volume. And remember, sometimes people look at market capitalization like big, you got some top 10 names that have huge market caps, but they have nothing to do with exactly what's going on with the actual asset itself. And this is their analysis. This is their liquidity versus market cap ranking. And the chart is very detailed, but it gives a comprehensive idea of which assets are more or less liquid than their market cap would suggest. So if you look at the line down the middle, at the very top, you got Bitcoin, ETH in the top left-hand corner. At the very bottom, you got things like Flow. Now, if the arrow on the left, the orange button, goes to the left towards the blue thing, it means better liquidity ranking relative to market cap. And if it's up and to the right, worse liquidity ranking relative to market cap. And here, the ones that stand out are BNB, bad liquidity; Polkadot, bad liquidity; Uniswap, bad liquidity; Leo, bad liquidity. What else is on there? Well, you can see for yourself. And ones that have better liquidity compared to market cap are names that stand out, like Matic, Doge, believe it or not, Chainlink, Ethereum Classic. So it's a bizarre thing. But again, watch for that when you are looking to position yourself. If there's no depth of market, no liquidity, you get bad spreads, it becomes very, very difficult to trade. So I thought that was a cool analysis to share. In addition, Tether is on the rise again. So good to bad news. This fell into the bad news category because some people believe Tether is not fully backed. But here you see Tether is now 49% again. And it went through a weak patch where it fell as low as 44%. USDC is 31.9% despite all the pumping behind that. Binance US dollar 11.3, DAI 3.8, Frax 0.7. And the rest are crumbs, but that is interesting to watch your stablecoins. I still believe if you have to sit in one, don't sit in it for long, and make sure it's USDC. In addition, this is also kind of interesting little analysis here. A quick recap of some of the top tech names. You got Tesla, Amazon, Google, Apple, Microsoft, and Nvidia with the price today and future earnings per share in 2023 estimates. I think Tesla earnings per share, despite coming down a lot. I think a week ago, Tesla EPS expectation for 2023 is about $4.60. Now it's down to $4.01. I think because of the sheer demand for the vehicles, I think the revenue is going to be very high. And the more they produce, the more margin they make per vehicle. So they can literally make it up in numbers, which is against proper thing. But the important thing is, if you look at the PEG ratio, we've spoken a lot about PEG on this channel, the compound annual growth rate. The upside is 54% for Tesla, and the fair price of Tesla based on this metric is $220. Fair price for Amazon, $79. It's currently trading 97, therefore it's 18% downside. Google, close to being fairly valued, 89 versus 99 the price, 10% downside. Apple, 23% downside. Microsoft, 3% downside, again, fairly valued. And Nvidia, which has been on fire lately, that price might be slightly off because I think it was 190, at least yesterday it was. But you can see it expects the fair price to be 130. So again, interesting to track and watch about how to allocate. There's no doubt in my mind that the screaming buy is top of the charts here. In addition, speaking of Apple, they do need a new phone. This is a beautiful breakdown from Apple's fiscal 2022 report of how the iPhone makes up 52.1% of their revenue, 20% is services, 10% is wearables. It's probably all the headsets that I lose. And 10% is Mac. I'm a Mac user and an iPad user. But it's so amazing to see how they are so dependent on that iPhone. Now, this brings in this little piece here. They're coming out with a new mixed reality headset, and it'll have a whole iOS-like interface that will include many functions available on the iPhone and iPad, and they put billions into developing this thing. It's going to come out, I think, this year. And the headset will serve as an external display for connecting to Mac, and users will be able to see their Mac's display in virtual reality, controlling the Mac with physical keyboard and trackpad movements by, I guess, going like this somehow. So a very heavily developed piece of machinery, but it's expected to cost $3,000, which could limit their market. But I guess maybe the more they can develop, who knows. But looks like a pair of snowboarding goggles. Let's talk about the S&P 500 weightings related to Apple. Apple is still the heavyweight there. You can see here, this is from Charlie Bolello on the left. He talks about the fact that Apple's weighting in the S&P 500 was 6.9% at the beginning of 2022, and at the end it had fallen to 6.26%. Also, what fell a lot is Tesla's allocation, now only 1.14% of the S&P 500. But that little chart on the right is mine. I put together all the weightings, all the price, some of the changes. And when you look at the top 10 companies of the S&P 500, okay, just the top 10, they make up 25% of the weightings. And when you go to the top 20 of the S&P 500, they make up 35% of the weightings. So it's really, when you look at the S&P 500, you only have to really look at the top 20 companies to get a feel for where it's going. In addition, let's talk about gold versus the dollar index. This is a cool little chart. And basically, since March 2022, the relationship between gold, which is in yellow in the chart, obviously, or I should say gold, and USD, the Dixie, in blue, has been tight. But gold's 2022 bottom coincided with the dollar peak in late September. Since then, gold is up 19% and the dollar is down over 10%. So they've got a very nice inverse correlation right there. And this bodes well for Bitcoin, because if gold is going up, typically Bitcoin does too. Now let's have a quick reminder. I tweeted this to Peter Schiff last night. He was talking about scaring people away from Bitcoin. But the reality is, everybody, and I'm not hammering gold here, but if you take gold divided by the M2 money supply, over the last 52 years, gold has yielded zero return. Whereas Bitcoin chart is very different. Go do it yourselves, ladies and gentlemen at home. Take your trading view, take gold divided by the M2, and take Bitcoin divided by the M2. You'll see a very, very different chart. So my money's on Bitcoin. And now let's switch gears and talk about Bitcoin. And I've got some interesting analysis to show you. And we're switching into the good news too. So first of all, Bitcoin has had the best January since 2013. And we'll go back in history now in a few slides. But this is quite impressive. The price of Bitcoin has increased roughly 39% since the start of the year, and making it a very positive start to 2023. So we spent a lot of time towards the end of 2022 talking about history and numbers and how the first 5 days of January for the stock market are very, very important, etc., and a whole bunch of other good stuff. So things are looking good. Now, this is a brilliant chart here, but it's not just a chart I want to dig into, but the numbers, what it actually means. And I'll do that on the next slide. So 68%, so where we are now. So I dug into the numbers to show exactly, going back in history to all the halvings, all the dates, calculate all the days, all the prices, and see exactly what this means. And it looks like this. So I put together a little table at the bottom if anybody wants to check my numbers. I know people like to try and see exactly what's behind this, but I ran a little Google sheet with some dates. So I pulled in the historical halving dates. First one was November 28th, 2012. Second, July 9th, 2016. Third, May 11th, 2020. You guys all remember that day because we were about 6 weeks into COVID and lockdowns and all that funny stuff. Anyhow, when you take the price and the days between the halving date and the 68 percentage days and get an actual date, you can calculate the time as to when the actual run begins. Now, why is that interesting? Because if you look at when the run begins, you got, May 13th, 2015, then you got 2/17, 2019, 12/30, 2022. All of them equate to the 68% of days equates to 897 for the first, 953 and 964. So it looks like the cycles are getting slightly longer. And the price at the beginning of the run, so take the run as to being after the orange ends. And the price for Bitcoin back on May 13th, 2015 was $235. And then the time until the actual halving is another 422 days, and the price went to 666. You cannot make this number up. That's the number of the beast for those who track that stuff. And the gain was 183.57%. Go to the second halving. You can see here the price at the run. At the beginning of the run was 3,633. We ran for 449 days, and the gainers were 140.99%. Now, here we are today. According to my calculations, which are to the day pretty much, this run began 12/30/2022, basically the eve of New Year's Eve last year. The price at that date was $16,641, and we have 453 days until the next halving, which will take us to 28th of March 2024. Now, the interesting thing here is Bitcoin's already gone up 38.17% in 25 days, and we still have 428 days to go. And if history repeats, and if I take an average of 183.57 plus 140.99, I get 162%, and that would take the price to 43,599, which is pretty incredible, because I did a video about a month ago, and I estimated the price of the halving being 43K. This backs it up too. So, not financial advice. We don't know where any of this is going to go. But if history repeats, this is fascinating to watch. Now, I look forward to coming back to it and see how it performs. Now, let's talk about Bitcoin 3 weeks in. How does it perform against everything else out there? Well, you got the MSCI emerging markets coming in at number 2, communication services number 3, gold number 4, consumer discretionary number 5, etc. But Bitcoin has won the day, year to date, absolute and risk-adjusted returns. It is winning. So who knows? But it's definitely getting a lot of people's attention. And we know for a fact, looking at on-chain data, big money is gathering and buying, and they're buying every single dip. That's why we have this kind of very stable price for a while. Big jumps up and now stable for a few days. Let's talk about Bitcoin over the last 12 months compared to other technology. I thought this was fascinating from Pantera Capital. Here you can see Tesla. This is only up until the January 17th when they put the report. So that Tesla number is now down around minus 55%. But Meta platforms down. They're just Facebook down 59% as well. PayPal down 58%. Bitcoin down 54%. Square down 53%. And Amazon down 42%. So you can see, people talk about, oh, Bitcoin's too volatile and everything else. Well, it's actually, you could argue, less volatile than tech stocks. Now, let's talk about what season we are in. We are still in Bitcoin season, or very close to it. Bitcoin season typically is defined as 25 and under. We are at 29 right now, and a long way off of alt season. But altcoins have been performing very, very well so far as well. In January, fear and greed. This is also interesting. The real news here is we are back at March, April 2022 levels. And of course, sometime April is when the market began to plunge a little bit. But getting back to this 50 level is very, very positive for the market. So the fear is gone for the first time in many months, which is nuts. Let's talk about Bitcoin tapping on the glass at 23K. By the way, if you want to follow me on Twitter, you can do that. But I tweeted this for fun last night. And you can find the link on my YouTube homepage. But you can see Bitcoin is still struggling with that $23,000 ceiling. Let me pop my trading view now because it's not even open. And you can see we're still banging it. Oh, it took a big dip, 300-point dip. So 22.6. So it just seems like that 23,000 level is when the short-term sellers are selling, of which a lot of them are in profit, which I'll talk about in a second. Now let's talk about fund flows. This is from James Butterfill from CoinShares. You can see the digital asset investment products had about 37 million flow in last week, and it was predominantly into short investment products. So people are beginning to buy insurance because of the huge run we have had. Also, the interesting thing about the money flows is the inflows are seen heavily in Europe, especially Germany and Switzerland, with about 14 million and 10 million respectively. Hong Kong saw outflows, as well as the US saw outflows, and the US put some money into the short Bitcoin positions. Let's break it down into detailed flows by asset. And a large number of altcoins saw inflows. Most notable were Ethereum, Polkadot. You have, let me see, XRP. They had a dump last week and now it's coming back in. Avalanche, and let me see, Solana had 100,000 flow in there too. Polygon. So it was kind of mixed, but overall very, very positive, with the exception of the big position to short Bitcoin. Now, let's talk about some of the short-term holders that are in profit. And these are the people that could be selling at 23,000. And you can see here from this chart from Glassnode, the percentage of short-term holder supply profit is now equivalent to prior bull market peaks. And the current value of 92% of short-term holder supply is in profit. So a lot of people ask, well, after a big 30% run, assuming they bought back on this January 1st, does it make sense to take some off the table? Yes, it can. But if you're in this for the long game and looking at some of the on-chain metrics about some of the big buyers coming in, I don't know, short-term sellers, when the big whales are buying, I think this could have more legs. But again, the problem we have is the macro. What will the Fed do on the 1st of Feb? What will earnings season look like for big tech? There's a lot of questions out there that are making people a little bit nervous, hence they're buying insurance. Now, getting back to the short-term holders, and now we look at the long-term holders, you can see that the Bitcoin long-term holder supply keeps growing. And I think Sanjay said this, you can pry these sats from my cold dead hands or something, but you're going to have a hard time getting them to sell at this level. These people have been through hell and back. They are holding and they're not giving up. And if you look at the supply, just going up and to the right as we go forward. So again, people are stacking. And of course, we're still very close to the bottom, still very close to realized price, still very close to historical generational buying opportunities. It doesn't really make sense to sell here. Yeah, it could go back to 21K. Yeah, it could go to 20K, maybe 18K if some really bad thing happens. But again, the upside far exceeds the downside. Now let's look at some of the other metrics that are very, very important. This is the long-term holders, the realized price, and the short-term holders cost basis. And we've smashed through those three different levels. So the long-term holder cost base is about 22,400. Boom, in the bag. Actually, we're $200 above it right now as we speak. Realized price, 19.6. And short-term holder cost base is 18.5. So being above those typically indicates a good sign for a rebound out there in the marketplace. And it also is a huge psychological shift in holder positions and holder behavior. Okay, we've been through hell and back. Now we're in profit. Should we, or even at just break even, should we just sell or hold and get some more? So people, I think, again, based on some of the other data, will probably hold. Let's look at another as well. Bitcoin exchange reserve is still draining. That's the purple line at the bottom, still going down, the amount of Bitcoin available on exchanges. As I said, it takes $50 billion to buy all of that up, and it's gone. And we're not going to get a supply crunch now, but one day we will. But it's nice to see the price rebounding and going in reverse to the amount that's available online. Let's talk about Bitcoin versus gold versus stocks. It's a cool little chart here. Again, they use different price axes and gains on the right, but you can see how they're all kind of following each other. But we know the winner so far in 2023 is Bitcoin, with gold coming in second and stocks coming in third. So again, it's probably the first time I've ever had 3 or 4 gold slides in a video. But it's important to look at what other markets are doing. Speaking of which, the big three last week, Bitcoin is still leading the market recovery, outperforming both ETH, which is only up 3%, and Binance 5%. Binance has rebounded very well after all the fear and fun flowing around. They did have some commingling of customer funds, which is a big no-no. But anyway, they're talking the way out of that right now. And the daily RSI is at unusual highs above 80, which gives me a little bit of cause. But spot trading volume remains very, very strong. And additionally, we see clear tendencies of increased institutional presence in the market based on derivative data from CME. So all things are looking up. And it's great to see the strength of Bitcoin, the dominance going up a little bit as well. Now, ETH holders as well. Switching gears for a second, 61.5% of ETH holders now addresses are in profit, which is big. And we haven't been this high since, I think it was August 2022. So good for the ETH holders. Now let's talk about a little article here from, I think it was Into the Block. And I'm not sure why they called the Apple of L1s, but Solana, but they did talk it up. Blockworks wrote this article, sorry. It was by Sebastian Sinclair. And they said Solana is now up 146% year to date with a market cap of roughly 9 billion, up 114% from its 30-day low of 4.2 billion. So it's been a crazy roller coaster ride. But the article did point out to the fact that the layer 1 ecosystem TVL has upticked to over a third of $1 billion after being as low as 250 million. And that's all per DeFi Llama. So it's still alive. Let's also talk about retail investors, because that's who you are out there. This is kind of stunning. And this is from Vanda Research. It was published in the Wall Street Journal. And individual investors have more than doubled down on Tesla stock. In fact, retail investors have spent more money on Tesla in the past 6 months than over the past 5 years. And in January, net purchases hit a one-day record. You can see the little green spike on the right. But meanwhile, the experts on Wall Street and US government, everybody seems to hate Elon. But somehow retail investors admire him. And I don't know why. Well, I do, because they're clever. But if you use your smarts and you look at when you look at people that run companies, you want to understand their track record and how good they are at allocating capital. So this is from Pomp here. I retweeted it earlier today or yesterday, I don't remember. But the fact that Elon Musk is the founder of OpenAI, everybody's talking about now, the maker of ChatGPT, since he was lost over, he's also the founder of PayPal, Tesla, SpaceX, Neuralink, the Boring Company, OpenAI. And this means that Elon has averaged a multi-billion-dollar company every 5 years for over 30 years. So again, look to people with good experience in allocating capital. He is special. Love him or hate him, I don't care, but he's special. One of the final pieces of news is this one. It is actually the final piece of news. You guys know, if you know the channel, you know I like personalities and how they map to behavior and investment styles and tools and methods, etc. And this is a very simple, crude study, but I thought it was kind of interesting. And that is extroverts, who are typically known for being outgoing and sociable in nature, are more likely to invest in digital assets than equities. And this is research by CryptoVantage, and they shared it with Finbold magazine yesterday or today. Now, the findings reveal that extroverts are likely to opt for Bitcoin, 73%, followed by stable coins at 50%. Additionally, extroverts are willing to put a significant share of their income at over $6,200 per year, and historically, they make good returns with over 14%. Now, this goes fly in the face to the research I've done, because the best investors typically are introverts. But the extroverts are YOLOing into crypto, which is kind of interesting. So it's prompted some ideas in my head to maybe do a revisit of, investor personality traits, trading types, and personalities, and all that type of stuff. So with that, everybody, a long show. Thank you for being here. And again, let me know if these things are too long, but there's just so much to share. And I read 300 articles plus a day, and there's just so much goodness that you all need to know. Also, good, bad, and ugly. Keep an eye on the bad and stay for the good. See you all. Thank you to the moderators in chat, and have a good night. See you all tomorrow. Bye.